Hello, everyone, and welcome to Richardson Capital Management's Economic and Investment Outlook for February 2023. My name is Mark Steele, and next to me, of course, is our Director of Investments, Dan Brown. So Dan, we saw February give back a lot of the gains that we picked up in January, both in stocks and bonds. What were some of the concerns that investors had that kind of sparked that change?
Sure, Mark. So a lot of the financial market narrative continues to revolve around inflation and what that means for the Federal Reserve. So we saw inflation pick up in the month of January. So we saw those readings in the month of February, and that unnerved investors quite a bit. So what this meant for the fixed income market is that interest rates moved up a fair amount, which caused negative returns for fixed income in really all categories of fixed income. And then what it meant for the stock market is that, again, investors became concerned about what that could mean for the Federal Reserve and their interest rate hiking campaign, thinking that that could last quite a bit longer, and the Fed could have more to do as far as raising interest rates. So a couple months back, we were noticing that a lot of investors were baking in the fact that the Federal Reserve would actually cut interest rates later this year. That seems to be off the table now, and investors think that the Fed funds interest rate could get as high as upwards of 5.5 by the middle of the year. And Mark, speaking of interest rates, we noticed that with the rising level of interest rates, mortgage rates are up. What has that done for the housing market?
Yeah, it's over the past 12 months, it's just been declining, and it's actually at the worst level it's been in a decade. Dan, a few months ago, you talked about how the level of expected corporate profits is just too high. Take into effect inflation, geopolitical concerns, higher rates. Are we seeing those earnings expectations come down?
Yeah, Mark, we are. In fact, just in the last 2 months here, since the beginning of the year, we've seen earning estimates for the full year 2023 move quite a bit lower. So the graph that we're showing here is looking at the past couple of years, and it's kind of showing that trend or that projection of how earnings expectations has progressed throughout the year. So if we look at the year 2023, for example, we noticed that analysts started publishing their estimates in 2021, and we saw a fairly gradual increase in expected earnings. And then that probably peaked around middle of last year. And then more recently, those estimates have come down for all the reasons that you mentioned. And more recently, we've seen as companies have reported their fourth quarter earnings, they've also provided some guidance on the full year of 2023. And we've seen expectations move quite a bit lower. So as we wrote about a couple months ago, we thought that earnings expectations were unrealistically high, and they've come down to more realistic levels. So we're encouraged by that. But we still think when it's all said and done that 2023 earnings will probably be a little bit less than 2022 earnings. And that causes us a little bit of concern because in years where we've had a contraction in earnings tend to be associated with recessions. So still not out of the realm of possibility that the U.S. economy could enter a recession sometime later this year.
So, Dan, you're paying a lot of attention to a lot of different things, but what else are we paying attention to?
Sure, Mark. So besides the fact that we're encouraged by the fact that earnings expectations are coming down to more realistic levels, we're also monitoring just overall valuation ratios. So we talked about that the past couple months also, thinking that valuations are just too high for the inflation environment that we're in and the fact that the Federal Reserve continues to raise interest rates. So we're waiting for a better opportunity for valuations to come down. So in the meantime, positioning really hasn't changed. So still a defensive posture, meaning that we're modestly underweight stocks and overweight money markets, which is yielding a very attractive 4.5%, which is, again, very attractive in this environment. But we're pretty confident that at some point in this year, we'll get the opportunity to redeploy those money market assets back into stocks.
Dan, we appreciate your outlook for the coming months and the second half of the year. On behalf of Dan, myself, and the rest of the team at Richardson Financial, we'd like to thank you for watching. Please be sure to hit like and subscribe. If you have a family member or a friend that you think would benefit from watching this report, please click the share button.